Hi, Steve Van Metre here, and welcome to your Monday Night Premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of markets that don't make a whole lot of sense. I want to thank everyone who watched my Friday video. I know there's people that get hundreds of thousands of views on YouTube, but the fact that I actually got over 100 was actually rather impressive. And we now have friends, I may have mentioned this, I'm not sure, but all the way as far as Hong Kong. So to my friends all over the country, all over the world now, thank you for listening. Thank you for the emails. Thank you for the phone calls. And I want to answer some questions that came up from that video. And I think it's really important because when you understand the monetary system, you kind of know exactly where interest rates are going to go. And if you know where interest rates are going to go, you know where the stock market and the economy is going to go. So one of the questions that came up today was, how do the banks actually create money? He said, Steve, you keep saying they create money out of thin air. I'm not sure I fully understand that. And perhaps there's some other people that don't either, so I thought I'd go over that. Now, there are two types of banking systems. There's called full reserve, which I don't even think exists in the world anymore today, but it used to probably a long time ago. And there's what is called fractional reserve, or fraction of a reserve, which is what we have today. So let me explain full reserve, and then we'll go to fractional reserve. So let's say there's a bank with $1 million on deposit, and they are a full reserve bank. They can lend out $1 million. They can only lend out what they have on deposit. So if depositors came in and pulled out some money and took it down to $900,000 in reserves, the bank could only have $900,000 in loans. And if their depositors put more money in, they could lend more money out. Must have dollar for dollar. In that case, you have a bank that's very solid because they have a dollar in deposit backing every loan. So you wouldn't expect to see a bank run, short of perhaps a need for liquidity by the depositors, and then the bank would simply call the loans in and recover their money. Now, the world today exists on fractional reserve banking. And central banks, such as the Federal Reserve, set the amount of money the bank can lend. So as I mentioned in a prior video, they can lend 9 times for every dollar. So let's say you have the same $1 million. The bank can have $1 million on deposit and have $9 million in outstanding loans. So they can take $1 million and turn it into 10. That is fractional reserve banking and how you create a massive credit expansion. So you have no credit expansion under full reserve bank because, well, a dollar on deposit can go out the back door, but you can't ever multiply it into more than one. But in a a fractional reserve, you get a massive credit expansion. And again, the amount that money can be multiplied is set by the Federal Reserve. So why do we have a central bank? Well, there's a good reason. Let's say that there's a bank with $1 million in deposit, has $9 million in loans, and the depositors came in one day and said, you know what, we want all our $1 million back. Now the bank has a problem. They have no reserves and $9 million of outstanding loans. So if you've ever heard me or a member of the Federal Reserve or someone talking about the monetary system say the Federal Reserve is a lender of last resort, that's why, because if depositors run to what's called a run on the bank, then the bank is insolvent because it doesn't have enough deposits to back its loans. And in turn, you need the Federal Reserve to step in to lend it money. So the question then is, where did that $9 million come from that the bank lent out? It's just a computer entry. It's not like they have a printing press in the back and they're cranking out a bunch of dollars, right? I mean, if you go buy a home, it's not like you go down to the bank and get a briefcase full of cash. It's just a computer entry that is tracked and regulated by the Federal Reserve. So literally the money is created out of thin air. So I think that's pretty interesting. Let's talk about crops. I just read the USDA report, and of course, rosy conditions again, despite the fact that all the stuff I'm reading from farmers say not even close to that. But it is what it is. There was claims by President Trump that China was going to begin large purchases of agricultural commodities in hopes to create a phase 1 trade deal that could now lead, according to Larry Kudlow, I forget financial. He's not a financial advisor, but he's an advisor to the White House, who said today that we could end up not having the tariff increase in December as long as things look like they were going well. Well, this is normally a time of the year that China does make large purchases of soybeans. and they're all buying them from Brazil. There's someone tracking tankers said, well, there's one soybean tanker leaving the East Coast, and look at all the ones leaving Brazil. They're buying all their soybeans from Brazil. Now, I'm not saying President Trump is right or wrong. This is not a political commentary. It's literally to state the facts, is that there's a lot of hope on this trade war because the stock market truly believes that trade war is the reason for the global economic slowdown. And if there is going to be a trade deal, then China would need to step up their purchases, according to President Trump. As of the moment, we're not seeing that. So I think that's kind of interesting. So moving on, I had to make some notes. So I want to talk about the overnight loans. Think of this like musical chairs, right? There's 6 chairs and there's 7 people, music, and then someone's left out. Now, someone said this weekend that, hey, these overnight repos aren't a big deal. Well, in a sense, that's true because they said this happens all the time. Correct. There are banks every night that are perhaps short money, and they go to other member banks of the Federal Reserve and get the liquidity they need. That's normal. It is not normal when the banks don't want to lend to each other because they look and say, man, your balance sheet looks pretty bad. I'm not sure I might get my money back tomorrow, so I don't want to loan it to you, right? That's what's going on. And so the Federal Reserve once again comes in as the lender of last resort, provide overnight liquidity. Now, it wouldn't be a big deal if this was just the tax, the third quarter estimated tax issue where there was a liquidity shortage, although there didn't need to be because it's not a mystery that the third quarter is when estimated taxes are due. But the fact that it's persisted now for over a month. There have been term loans where the Fed has done, instead of overnight loans, they've also added 6 and 14-day loans. They've done now as of today, $28 billion in quantitative easing where they've bought short-term Treasury bills. So it tells you there's something seriously wrong. The only question then is, why is the market ignoring it? Because that's what markets do. Markets ignore problems until they become bad things. And so one of the reasons I had to make a decision to move in and take a higher risk in the bond market that is, in the short term moved against us, but it will return. We're going to go through and look at some charts. It's probably going to go longer than 15 minutes, but I've got a lot to talk about. So I hope you're okay with that. And I want you to see some of this. I did something cool with some data this week, and I want you to see that as well. Anyways, back in 2008 and 9, banks provided liquidity to the markets. If you ever watched one of those movies about Wall Street, you remember those big giant floors of big tall buildings just full of computers and traders. Those are called prop desks or proprietary trading desks, meaning those people traded bank money and provided liquidity to the markets. They did other transactions for their clients, but they also provided liquidity to the market when necessary. They don't exist anymore. Liquidity today is provided by computers that trade in milliseconds at all hours of the day and have seemed to figure out how to manipulate the markets to their advantage. So back in 2008, when the bond market hit a bull market and it pulled liquidity out of the stock market and it plunged, you had 4 to 6 weeks where if you could try to play chase, you could try to chase the bond market higher and make some money. But that was when we had prop desks, when we had human traders. We didn't have computers waiting until 1 a.m. when trading volumes were micro thin and then jamming contracts in. So if you think back to Brexit back in 2016, when that hit the news, the market just went crazy because the computer algorithm, thought asset prices were mispriced, and then overnight things just plunged. They shouldn't have. And what happened the night President Trump got elected? Again, the market wasn't expecting that. We saw this massive moving of securities due to the computer algorithm. For all I know, these things that what once took 4 to 6 weeks, maybe 4 to 6 days, because these computer algorithms may just switch on a dime, dump their equity positions and throw them all into bonds. I don't know. All I know is this move in the bond market is only going higher. The content of this video provides educational information only. It's not intended to provide investment or other advice. This material is not to be construed as recommendation or solicitation by selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, my own personal capacity. Opinions expressed in the video that I own do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So again, coming back to the musical chairs, think of these overnight repos as literally there's a shortage of money. there's 28 banks and there's maybe 26 chairs, and at the end of when the music stops in the morning and they have to post their requirements to the Fed that they have enough liquidity and they're short, they put their hands up and put their offer in and bid on some overnight money. The question is that I have is, what would happen to the markets tomorrow if the overnight liquidity, which has been, banks have been demanding, say, around 60 billion a day ish, could be a little more if you factor the term operations that are 6 or 14 days long. I don't have the exact number. I'm just going to say around 60 billion a day of dollar liquidity. What happens tomorrow, or what would happen to markets tomorrow if that jumped to 200 billion or 300 or 500 or $1 trillion? You say, well, it can't be $1 trillion. Yeah, it can actually. It really could. So the question is, how fast would markets reprice risk? And you look at today, the largest S&P 500 exchange traded fund, symbol SPY, which once traded 400 to 600 million shares a day, traded around 32.8 million shares, which was about half of what it did the day before last Thanksgiving when the markets closed early due to a holiday. So what we're seeing is there's not a lot of buyers in the market. What happens if there's a massive repricing of risk? Where do you think interest rates are going to go? And you miss it. So in this market, you almost have to get in a little early and stomach through the volatility. All right, let me close the PowerPoint down. I got some stuff I want to look at, and let me get that loaded up here. All right, so the USDA putting out rosy information about crops still, but there's more cold, freezing weather headed through to the Midwest over the next 6 to 10 days, and then another, I think this is the same one, but according to the weather services that I saw, there's actually 2 separate storms that are going to impact. And so harvesting is coming right down here right now in the south because it's really cold up here and the conditions aren't that great. Looking at market liquidity, the NASDAQ McClellan Summation Index is still in negative turf, trying not to get down to 300, but given the low trading volume, it kind of makes me wonder how markets are able to hold up through all this. Of course, there's no economic news today from the U.S. that could help a little bit. Now, before we get into the hedge fund data, I don't recall if I looked at this. I think we did the real estate loans on Friday, and you can see on a 3-month basis they're really, really low. And so it kind of made me think, well, what if we went back, and I'm going to pull up my trading software here and say, when were they last low? Well, interest rates were last low right around August, September of 2016. Okay, so let's go up here and look for August. Look at the 3-month rate of change. It was like double what it is now. It's pretty high. And the year-over-year rate of change was more than double. So the next low going back was roughly August, September 2012. So here we go. Now this was negative, and this was pretty ugly. And then it picked back up. So the fact is, this short-term increase in yields that we're seeing doesn't make a lot of sense based on the fact that the data is suggesting that real estate loans, which are the largest loans, 4.5 trillion, are slowing down. Now, I did something cool that I did. I'm going to check and make sure you still see me. Okay. I merged the commercial industrial lending and the real estate loans. And I'll show. First, let me show you over here. I did it through the Federal Reserve website, which is pretty handy. And so you can kind of see that you normally don't get a year-over-year rate of change that crosses through zero till after the recession. In fact, I even went as far to look at commercial industrial lending, and it never has contracted. And we're talking the last 2 recessions, maybe before them. I'm talking really looking at post coming off the dollar standard. I mean, because the gold standard, the post 1971, it's never on a 3-month basis gone negative before the stock market had already bottomed. While the stock market was up. So in March of 2008, when the stock market bottomed, commercial industrial lending started to contract. This will be the first time it's contracted going into recession. What I think is a big problem is you have these really long expansions. And all that leads is more time for the economic data to deteriorate going into the expansion. So I pulled that commercial industrial lending data down, and let me show you where we did that. And so here's the two combined. $6.88 billion or $1 trillion of loans. If I said billion on the real estate one, I meant trillion. $6.88 trillion of loans, and it's growing at a 3.84% on a year-over-year basis, 1% on a 6-month rate of change, which tells us that the year-over-year would need to drop to 2 to validate that. And then on a quarterly, every 3-month basis, it's 3.1. Multiplied by 4, it's 1.2, which says both of these numbers are too high. So let's go back to 2016. What do we say? August, September-ish, somewhere right in here. Look at the big difference in numbers. You're talking a 3-month rate of change, which was over 1%. So it was 4 times higher than it is now. The 6-month rate of change was about 3 times higher, and the year-over-year was more than double. So let's go back to 2012. And somewhere around the same time, we have the same slow pace, but it started to pick up pretty quick after it bottomed out. And the year-over-year change was held pretty steady. And we saw a 6-month rate of change slow a little bit and then pick back up. So if the markets are right and this increase in interest rates in the short term is correct, it should be validated by that data at some point. So far it hasn't, but it should be. Now the question is at the end of a 10-year expansion, when financial conditions are tightening, is there a demand for loans? Well, not usually. And that's what makes it interesting. So what we're seeing in the markets are a lot of speculation. Now, what's interesting is we saw the speculators as of Wednesday of last week back off their short positions a little bit, a little, tiny bit. But keep in mind what happened last week by Wednesday. Well, we had retail sales data come out. And what did retail sales data? It showed a decrease, whereas the market expected an increase. And they backed off their 30-year shorts a little bit. Now, does that mean they have not added back since then? They could have. So there's definitely some selling going on here. It could be the smart money selling, trying to push people out so they could buy at a lower point. That would not surprise me a bit because they know how the market works and they want to add to their positions. Maybe the banks are still selling a little bit, looking to add back. We won't know that until Friday. Looking at oil, speculative long oil contracts back down a little bit. Oil, is telling us that there's no need for an increase in interest rates because oil is a great barometer for inflation. S&P 500 futures, they backed off a little bit, and gold futures backed off. That's got a long ways to come down. NASDAQ added to their tech longs and backed off a little of the Russell 2000 longs, maintained their dollar longs. But here's what's interesting. Big increase in their volatility shorts, almost getting close to the all-time low in volatility. And when volatility gets low enough, markets spring higher, or volatility springs higher, and equity prices spring lower, and you get a major mispricing in the markets, which leads to generally lower interest rates. So again, you see all this stuff going on, and it tells you that, well, some of the stuff doesn't make a lot of sense. So let me show you this chart here, and we'll add 10-year Treasury yields. I know generally real estate loans are longer, but I don't know what commercial loan, since I'm not a market I'm familiar with, I don't know if they're 10 years, 15 years, 20 years. I have no clue. So we're just going to use 10 years because we know 30-year yields follow 10, and so we'll look at that. There we go. And we can see by zooming in here, back that up a little bit, that the year-over-year rate of change is falling. The market's trying to say, no, we disagree with this, but the reality is this is headed lower. So the bottom line is this backup in yields is short-term. To what end, I don't know. Will it be an economic data point that comes out? Will it be some news on the trade war that changes it? Is it just going to be big banks coming back in and buying? Could it be some overnight repo problems? I don't know. I'm not really sure. Okay, so let's go and look at the charts. Like I said, we're going to run just a little bit long tonight, but wait a minute. There we go. But I want to show you a couple things. So first of all, a major concern only would be is if 10-year Treasury will start closing above this 1.9% number for a weekly close. Not likely to happen. But let's look at the gaps. So markets have been gapping all over the place. And here you can see an overnight gap up. So when gaps occur, so here you can see here's a gap. It gets filled later on, meaning the market eventually came back, brought yields down to find out what was going on. Why did somebody get missed out? Here's a gap that went down, gap down, and look what happened. You had a gap up to close it, and then prices moved down the next day to close the second gap. So as far as markets are concerned, they really like to close gaps. So here's a gap from last night. So we'll expect that to close. Here's a gap between here. That will close. And down here, you see this big gap, boom, from this low up to here. Well, look, it never got closed, and it's right near the all-time low. Same with 30-year yields. You see, oops, gap. Now, that doesn't have the gap here, but 30 years are going to follow the 10s. And then you have a big gap right down here, right near their all-time low. So at some point, yields are going to come back down, at least close their gaps. So we'll find out what's going on with that. Now I do know people are concerned that, hey, this could be a much broader sell-off. Well, remember, short-term yields or long-term yields follow short-term yields. So let's go here. Or here's short-term yields. First of all, have they moved much? Yeah, they went down a little bit, but no, they have not. So let's go and overlay. Oops. Long U.S. Treasury bonds. Notice how they're down and these are up. You say, well, it looks like they follow each other. Looks a little bit better now, doesn't it? So here you can see a point where long bonds were falling, short-term bonds were rising, and all of a sudden, long-term bonds took off. So here, long-term bonds were falling, short-term bonds went down a little bit and rose, dipped and rose, and boom, long-term bonds went up. So, well, that's just a one-year chart. All right, well, here's a two-year chart. Same thing. Long-term bonds leading away down, short-term bonds gap down, took off, long-term bonds fall. So you can see right up here is telling us that long-term bonds are likely to turn around because they do follow short-term bonds. And how is that likely? Well, the question you should ask then is short-term bonds going to lose value? Well, the Fed is trying to lower short-term interest rates. So that means they should increase in value and long-term bonds should head back higher. Again, this is a short-term move. We can see that on TLT here, it came down, is holding the support. Where's the support going back to? Can't see it there. It's going back to now all the way back to the February 2015 high, kind of the bottom of the 2016 range. And it's getting close to its 100-day moving average, which it ought to probably touch, I'm guessing, tomorrow or the next day. So what did we see? We saw a bit of increase in volume. And then on today, we saw this kind of bottoming pattern. We're seeing some selling in after hours. It kind of looks like to me that the market is just, the big players are trying to flush out the weak players. Because when it broke support here, look, boom, volume came in and picked it back up. So again, do I like it? No, but this is a sideways pattern. And we know that short-term rates are headed lower because the Fed is cutting, expected to cut rates. There's now an extremely high probability the Fed cuts rates at the end of the month, and that is good news. So this move here is temporary. Plus, if you want to look at the gaps here, there's a gap here. Here, let's go to the 90-day chart and find out where are the gaps. We got a gap here, maybe a gap here. I don't know if they're going to count that holiday or not, but there's definitely a gap there. And here's that big gap near the all-time high. So most likely it comes back up here, fills this in before all is said and done. But it did manage to come down and fill this gap. and it's filled some of these other ones in here. So it's been very orderly, but there's a gap here from last night, and I suspect that will be filled. So anyways, I'm glad to hear that everyone really thought some value into that. Markets will not settle until, or the monetary system will not heal until long-term rates go down. And when you understand that, you understand where you want to be positioned. And now it's just a waiting game to let the data just work itself out, let the Fed cut until the market starts to panic. And of course, we'll be back Wednesday with more thoughts and maybe some more economic data. We'll see what's available then. I'm Steve Van Metre. Bye now.